Today on the Altimetry Authority, we've got the cure for the recession blues.
So if you're really worried about the recession, you want to know where there's a not just a safe haven, but a real opportunity, we'll show you where that is. And it's probably not what you're thinking.
We've also got a real discussion about whether or not this current obsession with the end of American exceptionalism is justified, or whether or not it's yet another point of hyperbole while people are talking about stuff that's never going to happen.
Wall Street is wrong again. You know we like to pick on Wall Street when they're wrong. Three of the biggest investment banks, and actually a bunch of them, have been out there screaming that the hyperscalers are done, and why you can still look at some real opportunities, may not with the hyperscalers themselves, but with the investments the hyperscalers could be making.
ServiceNow has been in the news with lots of people cutting their targets without doing so much in terms of what they actually view for the company. Which part of what they're saying is true, and which part of what they're saying is an example of Wall Street getting it all wrong again?
Finally, on Earnings Uncensored, we're going to cover U.S. solar tariffs, the giant 3,500% tariff, and why this might actually be the boon for a stock that you might want to start looking at, and soon.
Let's talk Earnings Uncensored. Favorite pastime.
So let me just say, earnings
Wall Street has 2.5x
because their compensation goes up.
Wall Street's wrong again.
The tariffs, the trade wars, all the questions coming up are scaring the heck out of people, and it's making people worry about the market, worry like crazy. The fact that the government is a big part of GDP, and if the government's going to be cutting like crazy, and if eventually the people that were fired, that got hired back, that might get fired again, and all the other cuts that come through might actually create a situation where there's a recession. That's what everyone's worried about. That's the big word, recession. And then, of course, that's created this worry, and the worry has created volatility, and it's having people think the dollar could weaken and expecting the dollar to weaken because of it, and that there might even be a Fed Reserve takeover and Powell may get kicked out. In the end of the day, everyone is worried about the bear market. So what do you do with your investing when everyone's worried about a bear market coming? Well, there is an answer to that. The answer is the real opportunity when people are worried about the market crashing, is the same opportunity that existed in 2007, 2008, 2009, where people made a lot of money in equities. And it's the same opportunity that existed in 2000, 2001, and after 9/11 in equities again, in the stock market specifically, where there was an area that is protected, that is a safe haven, that still makes money. And that is, right, it's a small cap stock arena. And when I say small cap, I mean small enough that Wall Street won't cover it, small enough that there's no analyst covering it, small enough that if you Google it, you see very, very little information about what's going on. That kind of a small cap stock. Because when you look at that, the research shows, not just academic research, but proven our biggest clients, and I like to remind people of the 300 biggest money managers in the world, 230 are using our work, and we get to spend a lot of time talking to some of the biggest investors, and this is what they say. They say, small caps have a low beta. That means when the larger market falls, if you go hunting in small cap land, yes, of course, lots of small caps also fall, but they're heavily uncorrelated. They will fall for different reasons, right? They're super uncorrelated. That's the quote. Uncorrelated, meaning if the tariffs are bad, if China does the wrong thing, if Putin does the wrong thing, these stocks can still go up. They can still go up 3 times, 4 times. I'm going to show you 10 times. It happens. And the reason is they have what they call high dispersion. So even when the median, and I'm talking about the Russell 2000, small stock index, even when the median is falling, I'm talking about over the last 30 years, at any given time, where the Russell 2000 is falling, more than 10 to 20% of the stocks that are in the Russell could actually be skyrocketing. By the way, you can also have companies in the Russell 2000 that are getting crushed at the same time. But what it's getting at is when the S&P 500 falls, it's very difficult to find a large cap company that doesn't fall. It just is, they're super correlated. But when the S&P 500 or the Russell fall, small cap stocks can easily, and do so all the time, go the opposite direction and go straight up. And that's where you ought to be fishing, because then you don't have to worry about all those worries that we just went through.
Yeah, I mean, to your point, Joel, there's this idea. I always remember I was at a lunch meeting with Cliff Asness, right? AQR, for those of you who don't know, one of the greatest quant investors out there. And he said, look, when the market goes down, right, there's a reason why everything in large cap land has a beta of 1, right? Because the only thing that starts to matter is market specific stuff. But I think, Joel, I mean, let's step back and talk about dispersion because
well, Rob, how much money?
Yeah.
Let's how much money was Asmus running when he made that comment?
Oh,
$300 million. $200 million?
No, I mean, yeah, to your point, hundreds of billions of dollars. He might even, no, he's not at
billions.
trillions of dollars, but hundreds of billions of dollars.
But that's part of the issue, is these giant firms, Rob, our biggest clients, right? Over 200, 300 biggest money managers cannot play in this space. And so when these funds have to sell because their clients are selling, so they're redeeming. People are selling their funds, so the fund owners have to sell, right? They have to sell whatever they own. But if they don't already own the small caps, there's no downward pressure. That's part of the reason so many small caps can actually do really well, even when the Russell's falling, because they don't have that absolute ownership where everybody owns Google and everyone owns NVIDIA and everyone owns Meta. And so when those funds have to sell, they create downward pressure on everything in the large caps.
Yeah, to your point. So I mean, like, while the Russell was down, 20%, and the Nasdaq was down 20 when the S&P was only down 12. Your point is, yeah, but that's the Russell. That's not actually the dispersion, which is the idea, right? Dispersion is this idea that how much does everything move together versus how much does everything move in different places, in different directions when you look at the aggregate versus its core component pieces. And that's the point that you're making here, Joel.
Let me do it with my hands. So with my hands, right, if this is the top of the S&P 500 and these are the bottom S&P 500 performers, when the S&P 500 goes up, they all kind of go up. When the S&P 500 falls, they all kind of fall. But in the Russell could be falling where the top of companies in the Russell, I'm talking about 10 to 20%. I'm talking about 10 to 20% of 2,000 companies could literally be going straight up at the same time. Could be going straight up at the same because the dispersion is massive.
The market is down. Yeah, exactly.
Right? Even if the market's down. So specifically, what all the research shows, even if the median stock of the Russell is down and down a lot, that doesn't mean that the top 10 to 20% can't be straight up. That doesn't happen with the S&P 500. It just doesn't. You can't have 20%. You can't have 100 stocks of the S&P 500 going up when the S&P 500 is falling. It never happens. It does happen with the Russell. And that's what they mean by high dispersion. So what are some good examples of this? So 2002, post 9/11, 2003, the market's in some kind of recovery, flat. Actually, the S&P was pretty much flat then. And Netflix, right, goes up 400% or more. And why did Netflix go up so much? Because Netflix back then was a small cap stock. It wasn't owned by every one of the big companies or big funds already. It wasn't owned by our biggest 200 plus clients that read our work, or the 200 plus investors, institutional investors. It wasn't. It was a tiny little company. And so when people said, "Oh, this company is going to embrace online business model because people now have a lot more broadband internet and they don't have to get a DVD, or they can do DVD via mail, but it's going to switch to online," suddenly Netflix takes off. Meaning firm-specific fundamentals matter when you're working with these small-cap stocks, and it doesn't matter what the tariffs are doing. Another great example, right, is Monster Beverage. So again, back in 2002, 3, 4, S&P was kind of flat. Monster Beverage went up 10 times. 10 times, right? It rocketed up. And why? Because they hit on a business model that worked, but more importantly, it wasn't already owned by all the big funds, where as those funds are selling, it creates downward pressure on everything that's owned. And the big funds own the big stocks. When you go to the small cap stocks, you get this opportunity. And to be specific, so Warren Buffett, who's running $300 billion or whatever, right? And says, well, Buffett's 200 something billion in cash, right? Or some crazy amount of money in cash. What did he sell to go to cash? Well, he was selling Apple. He was selling giant stocks in the S&P 500, gigantic stocks. You know what he wasn't selling? The stocks that he doesn't buy in the first place. You know what those are? Small caps. Because he says, I'm so big, I can't afford to be buying these small cap stocks. And yet, where do you get the biggest performance? Well, 46% of all mega caps today, right, of the biggest companies in the U.S., right, were once little micro cap or small cap stocks. Meaning, we had these opportunities where they went up 10x. By the way, this doesn't happen in the rest of the world. This only happens in the United States. I mean, it can happen once in a blue moon in another country. But it happens regularly in the United States, and Buffett can't buy those stocks. He has to wait until the company's already a $20 billion company or a $50 billion company. Whereas if we go back and we find those little companies, meaning if we play in that pool, we don't have to worry about the tariffs. We don't have to worry about the big funds selling. We don't have to have a discussion about interest rates. All we have to do is say, is this company going to generate a lot more earnings in the next 3 years than it is now? You say yes, you buy the stock. That was Netflix back then, right? That was Monster and a whole host of other companies. Again, to quote Buffett, it's a huge structural advantage to not have a lot of money. So I'll tell you who's not interested in this presentation I have right now, right, in this discussion. our biggest 200 readers, right? The institutional investors, the people running 50 billion, 100 billion, $1 trillion, do not want to hear this presentation like, yes, we agree. They might be interested in their personal accounts, because in their personal accounts they're doing it, I can promise you, right? They're making these bets, but they're not making the bets with the $1 billion, $10 billion, $50 billion funds, because they can't afford to, right? They can't afford to. So what Buffett said was, if I could play in that small cap, micro cap market, I could make you, he said, I could make you 50% a year on $1 million. And he said, no, I know I could. I guarantee that. Then that's why for financial advisors and families and individuals who aren't managing $1 billion, right, or $10 billion, you perfectly well can go in this space and crush it. But you don't hear about this on the news because Wall Street doesn't cover these companies, right? Wall Street, Goldman Sachs isn't covering little companies smaller than 5 billion, 3 billion, 2 billion. A few here and there maybe.
There's no money in
their
it.
IPO.
Yeah.
Right? But there's no money in it. They want the companies that are making $10 billion acquisitions. Well, a $1 billion company doesn't do this. So one of our great picks going back to 2008, 2009, when everyone's screaming, oh no, the wall of worry, the market's getting crushed. And we looked and we found this company, Middleby. And I'll tell you, I went to a lot of our clients, right, our biggest clients, and they're like, Joel, it's $800 million company. I'm going to have to buy the entire company. I'm managing $10 billion. Don't show me stocks like this. And I was like, well, I just want to share it with you. And he was like, yeah, great, nice. Maybe I'll buy it in my personal account. That's what they say. Maybe on my personal account, but there's no way my fund can buy this. I've got too much money, right? But the RIAs, the financial advisors, the individuals, the families were like, well, I could put 50 grand in that name. I could put 100 grand. I could put 200 grand and watch that stock rocket up 10x times, because that's exactly what happened, right? Because Middleby wasn't trading on interest rates and QE and everything else. It was trading on pretty much every restaurant at some point has bought a Middleby product. And as long as people eat in restaurants, as long as restaurants make food, or as long as restaurants deliver food, that's an important point, which I'm going to get to, right, 12 years after 2008. As long as they deliver, they have to buy their products, they have to buy their ovens, they have to buy their dishwasher things and microwaves and whatever else. And so Middleby is going to still do very, very well. And it was priced as if it was never going to sell another piece of equipment. I mean, it was priced so cheaply. Mm-hmm. So you got this bargain, crazy bargain, and you could buy in. By the way, once it hits 2-3 billion, then the institutions start looking at it, and that carries
and then it gets turbocharged.
Yeah,
right. Exactly.
Then it gets turbocharged. Right, and you get this launch point,
which is how you get, right? I mean, 800% upside in the span of a few years, which is what's wild here for this one.
So the real opportunity when worried about the market, and let's go to 2020 and bring up 2020. So one of the stocks that I went out recommending like crazy was LGI Homes. You said, but that's a home builder. Like, yes. And what did people realize very quickly during the pandemic? They're going to spend a lot more time at home. People needed a bigger home. They're going to move out of the apartment to a home. They didn't want to live in some building with 400 other people there because they're worried that everyone's going to get each other sick. I want my own home with my own yard where I can actually maybe go outside, because that's what people are thinking. And guess what happened? LGI Homes went out, I don't know, 200% or something? I mean, it was a fantastic run.
Yeah, even from before the pandemic, it doubled in basically less than a year, right? And that's before the pandemic. And obviously, the stock price dropped shortly and then bounced back fast.
A small cap name, barely covered by Wall Street. Nobody was looking at it. That was the situation, and was fantastic. It was one of our best stock picks, right, that year when the market did what, 11% in 2020?
Yeah. Exactly. I mean, and that wasn't just that. I mean, we had Sonos, which was a company that, while everybody was wondering what was going to go on with the market, it was benefiting from people wanting more, basically really more audio, right? Being able to entertain themselves at home and listening to the TV and listening to music and anything else. And that stock, I mean, when we recommended it, jumped more than 150 something percent. Or EXP World, which was a company that we highlighted in June of 2020, and then went on to go up over 850% when we were recommending it. And so, I mean, right, Joel, to your point, yeah, this is why this is the kind of
even when the greater market is falling, even when the greater market is falling, you're worried about, recession, everything else. Good, right? You should be worried about that. We're concerned. We're watching it. We're trying to see what's going on, right? But it doesn't matter, because when you buy these smaller companies that don't have the downward pressure, because they're not being sold when the big funds are selling, because they don't own them. They're not being covered by Wall Street, so you don't hear about them. You don't hear about them in the news because CNBC pretty much parrots what Goldman Sachs or whoever's saying. They're just repeating that stuff on big names like Apple and Nvidia. But you find these other smaller companies, and that's where you can crush it. That's where you can win, and it doesn't matter what happens. It really doesn't matter what happens. So you just have to find the themes and what to do with it. So where to go now is small caps, right? If you're worried about tariffs, you're worried about the recession, you're worried about interest rates, you go for companies that are going to have earning power no matter what, who aren't already owned by the big funds. So there's no downward pressure. And in fact, when the big funds see these companies cross, like go from 500 million to $1 billion or $1 billion to $2 billion, then they start paying attention and buying them up because the funds are still looking for stocks. They can't look for ones that are too small. And there's two fantastic themes, and Rob will explain it, but it's AI enablers is one of them. All right, I'm not talking about NVIDIA and trying to make a bet on which way NVIDIA is going to go. I think NVIDIA has great prospects over the next several years, but that doesn't mean I'm going to try to make a bet on it right now. But the ones I will make a bet on is the AI enablers, who I know are smaller, who aren't getting sold off by the big funds that have to sell stocks when people pull their money out of the fund. You pull your money out of a fund, the fund has to sell the stocks in the fund. These companies are not owned by those big funds. And yet, you see them doubling earnings or tripling earnings or getting all these contracts from all the big AI companies. The AI enablers, right, where we know the money's still being spent, are going to take off like crazy. And that's where your money can be in 2025, regardless of what you think is going to happen with the tariffs or recession or anything else like that. The second one, Rob, is the supply chain supercycle. Let me let you hit that because I know you've been loving that one, and that's another area that's going to do well.
Yeah, I mean, it's pretty simple, right? It's just that idea of, look, we are seeing a massive investment in the United States in terms of rebuilding supply chains, nearshoring, onshoring. This was happening long before the tariffs came out, and it's just going to continue to happen, especially if we're going to think about rebuilding supply chains to be a reform of globalization ex-US. But, Joel, right, the whole entire idea here is small caps are obviously a place that everybody knows you want to buy small caps in a good market. But your point is small caps actually can be a great safe haven in a bear market too. It's kind of a heads you win, tails you don't lose phenomenon in small caps. But
yes,
let's talk now a little bit about why everybody thinks that we're in a bear market or that we're bound for a bear market, and the real reason why people are probably missing the picture here, which is, right, everybody is calling right now for a bear market because everybody thinks that we are heading for the end of U.S. exceptionalism, right? If you've been reading anything or listening to anything in the last 2 weeks or so, you've almost certainly heard a lot of people starting to throw around this term. Just recently, the head of Societe Generale, their head of asset allocation, talked about how between breaking trade patterns, breaking the U.S. dollar, and everything else, that the U.S., Joel, is done, right? The U.S. exceptionalism is over. And I mean, right, he's not the only one who said it also. There's plenty of people who we've heard say it over and over and over again.
Oh, Mohammed Al-Arian has been all over the news saying, right, that, oh my God, the U.S. economy is done for, it's over. He's been saying that since 2010, by the way. How is that trade done, right? And then in 2020, it was like, oh, but now the pandemic has hit. The U.S. is not going to be able to make it out of that. And the S&P actually finished up in 2020. In 2020, while Muhammad Ali is saying this. Another one, Robert Kiyosaki, the rich dad, poor dad guy. My goodness, you can't, swing a dead cat and not run into him somewhere on some station where someone's allowing to get out and say, the dollar is worth less than toilet paper. I'll make that trade right now. He wants to trade me my toilet paper for his dollars. I will do that right now. I'll take all his dollars and give up the toilet paper. But the fact is, right, what they're looking at gets headlines, they get known, whatever else. And Kiyosaki's been saying this literally for 15 years while the stock market has done this, right? And the economy of the U.S. has done this. So, no, they're wrong again. They just are.
I think for Kiyosaki, in fairness to him, that comment was really actually just from April of 2020, and people just keep on recording that and playing it over and over again, because right then I do actually think that was a moment where toilet paper may have been more valuable than U.S. dollars. But that was a once in a millennia thing. That was not a normal thing. But Joel,
supply chain issues aside, yes.
But Joel, let's talk about the real reason why. If you want to talk about the actual core of American exceptionalism, everybody, the core of American exceptionalism isn't any of the stuff that anybody was talking about. It really, Joel, comes to the U.S. Constitution and maybe something that happened just before the U.S. Constitution. Is that fair?
So the fact is, the core of economic exceptionalism, the why the U.S. is where every business really still wants to be. Not every single one in the world, but why is it the S&P 500 include 490 of the greatest companies on the planet, right? Throw in another 10 from some other countries, or 20 or 30 maybe. All right, you could even go 50 depending on what metric you're using, right? But the fact is, U.S. companies generate more economic profit than the rest of the world's companies combined. Bar none. It's not even close. Generate more economic earnings. And why? One of the reasons is U.S. companies, where do they come from? They come from creative destruction, meaning from entrepreneurs in the U.S. that, yes, there's GM and yes, there's Ford, and Tesla pops up out of nowhere and says, no, I could be bigger and better. That doesn't happen in other countries. That doesn't happen in Japan. That doesn't happen in China. In China, if someone says, I'm going to take down the big banks, like Jack Ma's put in hotel prison for the next 3 months. It's almost like he literally, figuratively got his tongue cut out. Some people say literally. I don't think it was literal, but it is figurative, right? They get his tongue cut out, and suddenly he doesn't talk anymore. He doesn't scream out against the banks. Whereas here, in the U.S., people can scream, I want to take down the biggest companies. GE used to be one of the biggest, and they're not. Where is it coming from? It's coming from an entrepreneurship that is brought about going back to the Bill of Rights, which goes back to what the Bill of Rights was based on, was saying, here's how we fix one of the segments, right? Not the preamble, but in the Declaration of Independence, and it starts with a G.
The longest segment of the
Declaration of Independence, which is the grievances. And if you look at the list of grievances, and the Bill of Rights says, we're not going to allow that in the U.S. Now, I'm not saying the U.S. doesn't sometimes fumble a little bit. It does, and it doesn't live up to everything in the Bill of Rights of the Constitution sometimes. But compare that to every other major country in the world, right? Where you do not have free speech in Great Britain right now. That is unquestionable. Even though Starmer was like, oh, yeah, we do. And Vance was like, no, you don't. They've been attacking free speech like crazy in Britain, right? In other countries of the world, you can't go out in Japan and say, screw you, Toyota. I'm taking you down. I'm going to build a better company than Toyota. You are not going to get partners. You are not going to get banked. You're not going to get any friends, because even the other car companies will be like, well, we're not going to allow that to happen. Right? If we're going to have an EV world, Toyota's going to make it an EV world, not some new startup like a new Tesla popping out of nowhere, right? And you can use this in every industry. The fact is, getting to everything is that the U.S. becomes the haven for entrepreneurship, for venture capital, which leads to the small companies that become the big companies. And that process doesn't happen anywhere in the world in scale the way the U.S. does. Nowhere in the world in scale the way the U.S. does.
Right, Joel, to your point, I mean, right, let's leave out the UK and Japan. I mean, let's just talk about, right, everybody thinks that, you know, that the US is basically giving up its lead of American exceptionalism to, say, for instance, China. If you look at that list of grievances and you were to go back and you were to look at what was said back in 1776, right, all of what the Declaration, all of what the, the Bill of Rights does really enshrines for the U.S. that we can protect that. And sure, you can, right, everybody's worried right now. They're saying, oh, the Declaration, the Bill of Rights,
Constitution's under attack.
Yeah,
right?
Yes, exactly.
Constitutional crisis.
And all those things could disrupt our, could disrupt our way of life. Well, there's a reason why we have, right, courts that are pushing back on anything that you would think of that you have the right to, right, push back on any of those conversations or anything like that. You want to go to China, which is the place that people think could theoretically supplant the U.S. in this conversation. Joel, I'm pretty sure that all those grievances, for the most part, still stick in a way that the Bill of Rights really protects us from them sticking in the United States.
No, if the Chinese people could read I don't know if they can, but if they read the Declaration of Independence, because I don't think it's allowed, but if they did read the Declaration of Independence and they read the grievances section, you'd be like, well, that's literally what I would write right now as a Chinese person living in China, right? Or in many countries of the world, right? Most of the countries of the world to this day, at least in the UN, are still more totalitarian, right? More dictatorship-like than they are democracy-like, which is unique for the United Nations. The United Nations is made up of more dictatorships than it is democracies, which is funny. Anyway, as long as the U.S. has what it has, it will attract entrepreneurship. It'll attract venture capital. The U.S. has more venture capital invested than double, possibly triple, the rest of the world combined. More angel investing than 5 to 10 times the rest of the world combined. Rich millionaire families are leaving China more every day than any country in the world, right? By the way, rich millionaire families are also leaving Britain more every day than than number 2 in the world. Russia's, I think, number 3, where rich millionaire Russians are leaving Russia, right, to say, I'm getting out of here. Then why are they leaving these countries that, are causing these problems? Because they said, I can't be free to be a business person. I can't be free to be an entrepreneur. I can't be free to do this if I don't have freedom of speech. Because freedom of speech is naturally disestablishment. Think about it. Freedom of speech, meaning an entrepreneur who engages in saying, I'm taking down Toyota, I'm going to take down Sony, I'm going to take down GM, I'm going to take down whatever. That is naturally disestablishment. So you need a country that has free speech so that an entrepreneur can flourish. And an entrepreneur cannot flourish in these other countries, which is why they still come to the U.S. As bad as it's gotten sometimes with things that people say, it still is not close to how bad it is, where the grievances that you could literally rewrite the grievances of Declaration of Independence in more than half of the countries around the world today and be correct and say, yes, your government has literally done half of those things in the last week, literally to the people of its own country.
And right to your point, Joel, I mean, that all that stuff, the ability that the Bill of Rights does to protect innovation, to protect our ability to innovate, and then when we create things to mean it's our own, is why the U.S. is the center of venture capital, and that's not changing anytime soon, is the center of innovation, and that's not changing anytime soon, and is the center of wealth creation, which is why, look, at the end of the day, everybody, you need to think of this as an opportunity when people are having this conversation about the end of American exceptionalism is an opportunity to recognize how bedrock that American exceptionalism is on how our way of life works. We're not something that we're going to worry about right now. Fair, Joel?
Buffett and people have said, well, Buffett's gone to cash. Yeah, but with the money he doesn't have in cash, which is a timing issue, right? He's timing when to get in. But the money he doesn't have in cash, he's not buying up Russian companies. He's not buying up companies in Africa. He's not buying up companies in India, right? With the money that Buffett doesn't have in cash, where is it? It's in U.S. equities, right? So he's timing what's happening, but he's not making a bet that U.S. companies are dead because all his equity ownership is still heavily U.S. companies, if not almost completely U.S. companies. And so, all right, as Buffett says, don't bet against America.
Exactly. And speaking of not betting against America, let's talk about people who are betting against some of the largest companies in America. And we're going to tell you this story about the hyperscalers and the narrative around the hyperscalers and what's missing in three parts of three different tweets. Because that is how it seems like the entire world gets their news nowadays, is either from Twitter or some other bite-sized component of doing this. So the first tweet we're going to show you here is the tweet that everybody's been talking about, right? So Cowen and Wells Fargo put out this report in April that basically said AWS is going pause on adding new
Amazon
data
Web
centers.
Services.
Right, Amazon Web Services. You've seen this about Microsoft, et cetera. And what we thought was interesting when we saw this tweet was, this looked like a really short. This is a tweet that has a picture of a research report. And Joel and I, having worked on Wall Street a little while, we're like, wow, Wall Street people normally aren't that pithy. We normally, need a lot of words to get across what we're trying to say. So 2 paragraphs for a research report looks a little weird. Well, you look a little deeper, and what you can see is if you don't just read the top of that report, which says AWS is on pause, you see just the rest of the front page of the report, which we saw from another tweet, something really important pops up, which is, I don't know, right below where that cropping happened is where they say, yeah, historically we see digestion periods like this that can last for 6 to 12 months. In no way, shape, or form do we think that this is a sign that we are seeing the hyperscalers saying that growth is over and that we don't need to build any more AI data centers. In fact, this is probably just a natural part of the cycle of what happens. Oh, by the way, it happened in early 2024 too, and it probably is going to happen in 2026. And then you go to the horse's mouth. Let's see what the people in AWS are saying, specifically the head of global data centers in Amazon, who says, yeah, the data that you're looking at isn't telling the whole entire story here. And so, right, if you step back and
there's a digestion time to the spend, and it's not perfectly straight line. It's a bit lumpy, right? But when you talk about what they're planning for the next several years, it's lumpy. Of course, all CapEx is lumpy. You don't spend exactly 1% of building a plant every day for 100 days. You spend a ton, and then you digest it, you make it work, plant, property, equipment, or data centers, right? And so the bigger picture is what are they going to do over the next 3 to 5 years, not, they're taking a pause for the next 2 months. I mean, honestly, who cares, right?
Exactly. Right. And so if you look, what we did is we said, hey, you know what? Let's step back and let's look at what the real data tells us in terms of, do we need to worry, first off, that the hyperscalers are running out of money to be able to invest in these data centers? And so what we did is, using uniform accounting, we went and we said, let's look at the 5 big hyperscalers, right? That's Microsoft, that's Google, Alphabet, that's Amazon, that's Meta, and that's Oracle, right? Which is really arguably the 5th big hyperscaler out there who's investing huge in building these data centers. We said, let's just look at their uniform earnings, right? When we clean up the accounting, we look at the real profitability. Joel, these companies produced $375 billion of earnings last year. That's just nuts when you actually think about it, how profitable these businesses are. And everybody, if you look, That ain't slowing down at all, right? In fact, it's forecasted to rise to 400.
Tariffs.
Yeah.
Rob.
Yes.
Tariffs.
Right?
I'm sorry. I couldn't help myself. Right. The fact is there are areas of the economy that are not affected or impacted by tariffs, right? And this is one of them, right? This is one of them. Look at these profits. These aren't going away.
If you're in a race for any of their products, right? Tariffs are not going to impact the demand for any of their products, and certainly not, right, AI and the explosion here. So, but then we said, okay, so we now know $375 billion of profits are being thrown off by these companies. And, call it in 2 years from now, we could be seeing $450 billion. So what do we know about their CapEx, right? CapEx, everybody, is how much you're reinvesting into the business. And this is growth CapEx. What that means is there's a level of money that you just need to spend if you have a data center to keep that data center running and current, right? That's called maintenance CapEx in terms of the idea of how much do we have to spend just to make sure that we can still fulfill what we've always been fulfilling. Exactly.
Yeah, just to keep your business
all this
the same
that we're
size,
talking about here.
You maintain the size of the business. Maintenance CapEx doesn't mean like maintenance of equipment. It means maintaining the size of the business, all right, is what we did not include in this chart. We took out the maintaining the size of the business. We said, no, how much CapEx went into growing it bigger than it already was, right? Bigger than it always was each year, and that's what you get these charts. This is the growth in each year.
Exactly. And what you can see is these companies are spending almost $325 billion a year in new building. Sure, in 2025, actually, growth CapEx might drop a little, meaning growth CapEx might drop a little. So they're only going to add another $300 billion of new data centers and whatnot on top of the massive data center footprint they already have, right? Remember, this is not meaning, they're cutting CapEx. This means they're reducing the speed at which their growth CapEx is growing for a period of time. And in 2026, they're actually forecasting it up to $350 billion. Sorry, go ahead, Joel.
Yeah, less growth doesn't mean shrinking. It means just not quite as much as last year, but still more than every other year in history except for the last two. All right? So they're still going to be spending in 2025 more than they've spent in any other year in all of history except for what they spent in 23 and 24. And it's still really close. It's still awfully close to what they spent in 23.
And this is the important nuance, everybody. And because of how much they invested in 2024, if we showed you the entire bar of actual CapEx, which includes maintenance CapEx, because of all the additions they made in 2024, the total CapEx bar is actually higher in 2025 than it was in 2024. But we just focused on growth CapEx. But when you want to talk about investment for these companies, just talking about CapEx, which is about property, plant, and equipment, and leases, isn't the whole entire way we want to look at it. So what we did is we actually captured also how much growth R&D investment are they making as well. And when you put that in, you can see these companies are investing so much in growth that they can fund from their existing cash flows, so we don't need to worry about it. But these companies are not slowing down growth at all. These are companies that are going to spend $350 billion in R&D and CapEx in 2026, 310 to 20 in 2025. This is not a story of AI that's slowing down. And everybody who's talking about that, and this comes back to the idea of this pessimism, Joel, right, of American exceptionalism being over, the AI trade is over, and everything else. Anybody who's telling that narrative is just missing the point, Joel, right?
Yes. No, this is like, we often say, from 1994 from 1994 to 2000, NASDAQ went up 600%. During that time frame, it pulled back more than 10%, 10 times, and one time it pulled back, 30%? Every one of those times is a screaming buying opportunity, and you would have crushed it have you done it. So the idea that the PC revolution or the internet, right, wasn't going to continue to change the world as we know it back then is sort of like someone saying right now, oh yeah, AI is in a pause and data centers in a pause and Amazon's not going to spend as much next month as they did last month. And so for that reason, I'm not going to make a bet on AI. Now, I'm not telling you to buy the big AI companies, but don't you think there's some interesting $5 billion, $10 billion, $3 billion AI enabling companies, frankly, that Wall Street doesn't talk about because they're too small for Wall Street business? They don't get someone's bonus at Goldman to increase enough, so Goldman won't cover that $2 billion company. Those are fantastic companies to cover. Those are fantastic companies to look at to buy.
Exactly. And so this is the whole entire point. The AI boom is not going anywhere. And so it's not just that the AI boom is not going anywhere to focus on those companies. It means there's an opportunity that Wall Street's not just getting the hyperscalers wrong again. It actually points to the to Wall Street getting another company in the AI space wrong again, which is ServiceNow. So Joel, right? So recently news came out, right? But JP Morgan and Canaccord and Citigroup, a bunch of others, all cut their estimates for their stock price, I should say, targets for ServiceNow. For those of you who don't know what ServiceNow is, by the way, big player in basically helping you run any of the boring, mundane things you have to run, from tickets for HR, tickets for IT, helping you basically access all of your infranet and your infrastructure and intelligence in your business. That this company is a huge AI enabler in that space, an AI user. Price targets cut by $200 to $400. So a lot of them dropped their stock targets from $1,400 for ServiceNow down to $1,000, $970 for JP Morgan. I think it was $1,020 for Citi, and call it $1,080 for Canaccord. But if you look at this, Joel, I mean, right, so, but all of them kept their outperform rating on ServiceNow. And that's what's so hilarious, right? It's like you're cutting your stock price by $200 to $400 and telling everybody that you don't think that this company is going to break its 52-week high, and yet you have it as an outperform. Doesn't make much sense, does it, Joel?
ServiceNow is a big company, Rob. I mean, they do a lot of banking business. They do big acquisitions. They're planning a gigantic, $30 billion acquisition? Is that right? Right? And that means the banks
$3 billion, but yeah, exactly. Yeah,
$3 billion. Sorry, they're planning a $3 billion acquisition. The banks are wanting to clamor to get their 7% of that, or 5% of that $3 billion for their, bonuses for Christmas or cocaine or whatever they spend their money on. The investment bankers do anyway. All right. I'm not picking on anyone in particular. I'm just saying in general it happens. Right, and so they're going to spend that kind of money. And yet, while they're saying outperform on ServiceNow, and this is a buy or a strong buy or an overweight or whatever silly term they want to use, they're actually giving target prices that are below where the stock has been in the last 3 months. Right, so you're saying, oh, well, we hope we're going to get back to that price. That is called, the institutional investors say, the nudge, nudge, wink, wink. They're saying it's an outperform because they want the CFO and the CEO to say, oh, yeah, thank you for giving us your support, so we'll do our banking business with you. And then behind the scenes, they're like, oh, by the way, the target price, I've brought it to a number that's lower than where it's been in the last just few months. Wink. All right, what are they saying?
Yep.
Right? What are they saying? They're saying that, that the outperform doesn't line up with their models. It just doesn't.
And so, I mean, if you look at it, Joel, right, when you look at the real data and you think about the AI narrative behind this company, it's clear that one of their two takes is actually wrong, and they do not compute, right? And so for everybody,
right, so,
if we step through, and Joel, you want to take everybody through this, yeah?
Yeah, so this is gap accounting. So if you go to Yahoo Finance or Google Finance or FactSet or Bloomberg or wherever and say, what is the return on assets? The earning power that Ben Graham and Warren Buffett and Charlie Munger and all the great investors have studied, the earning power of a company is what drives the stock up or down ultimately. They would say the earning power, its ability to generate earnings on its assets, right, is very low. It's not even a 6.5%, 4%. Well, this is reality. That's using uniform accounting, because Buffett and all the great investors say you can't trust GAAP accounting, or IFRS for that matter. International financial reporting standards are actually worse than U.S. GAAP. They are. Any accountants want to have a discussion about that, please ping me. All right, so anyway, it's worse, but under U.S. GAAP, it's still terrible, and nobody worth their salt. So we convert to uniform accounting, which uses the same accounting and the same electives, right, over the last 20, 30 years. So we have a nice comparable. And what it says is ServiceNow is actually a super high-return company. Global corporate average is 6%. China and Germany are like a 4% return on assets on average. And U.S. average is somewhere between 12 and 14%. And ServiceNow is getting close to 35% return on assets.
Exactly.
This is a phenomenal business. This is not a bad business. And if we look at the forecasts, right, based on the analysts back of the research, meaning where they actually do pro forma forecasts that we can gather from all of the, and really it's done by the research associates. It's the junior people that actually still have, a sense, regardless of the, outperform or target prices that don't line up. So the junior analysts put this together. They put it in the back of the research report. We're able to gather it all. And it says that they believe that ServiceNow actually is going to have increasing return on assets over the next 2 years. Those are the light blue bars. The actuals are the dark blue. The light blue bars are forecasts based on quarterly numbers that we already have and right forecasts from the analysts, meaning the actual detailed pro forma forecast. And then the white bars are getting to what's priced in the stock. So to get to the current $814 stock price, right, or wherever it's at, $800 stock price it is right now, you need these returns to follow what the, I'll say, junior financial analysts at the Wall Street firms are thinking, and follow that up over the next 3 years and then plateau it around 70% and hold it in perpetuity. That is a tough statement. That's expensive. That's going to tell you why some of the analysts are saying, hey, this is an outperform, but I'm giving a target price that's lower than where it's been in just the last 6 months, right? Nudge, nudge. That's the reason they're doing it.
But the best thing about this, Joel, is this is one, oftentimes we pick on Wall Street in this case, JP Morgan, Canaccord, and Citi, because of the fact that it's brazenly obvious that they are telling people one thing and actually they really believe another thing. And we're like, well, clearly they think this. In this situation, they have a problem where effectively both of their conclusions are wrong. Because either you think that this company and that AI is done for this company and that it's running out of time, in which case your stock price target shouldn't be $970 or $980 when this stock is it. It should be $200 based on how high these expectations are. Well, on the flip side, and also obviously you shouldn't have an outperform. But if you really do think that this company is going to go gangbusters, that it's doing this well, quite frankly, your stock price target should be way higher for the business, because every single time that ROA goes up, the actual price target should rise, because you basically secure in that next year of profitability. So those price targets should be way, way, way higher if they are right for their outperform. So this is one of those awesome times that Wall Street is actually getting it wrong both ways, no matter what happens.
They're saying to the world, outperform, because they don't want to lose a banking business, right? Outperform, buy, strong buy. Meanwhile, they're giving target prices that are below where the stock has already been, right? Which is just insane. But the reality is either this stock is really way, 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 way down, or you believe in the AI and the stock is a double or a triple. It's not something in between. It's not something in Wall Street. It seems like no one on Wall Street has gotten that correct, right? And just said it bluntly instead of openly. I don't know why. It's too bad.
No, that's right. Yeah, exactly. And so, obviously all this is about, what Wall Street's getting wrong. Now let's talk about a picture that people are sleeping on, possibly because of the fact that this company is small enough that nobody's paying attention to it. Let's talk about some news that came out around tariffs. That was even an eye-popping number with how eye-popping tariffs have been recently. We've seen 125% tariffs. We've seen all sorts of numbers. Are you ready for a quadruple digit number? The U.S. imposed tariffs a week or two ago on Asian solar imports. Nope, not saying Chinese, Asian. So this is Southeast Asia and China, of 3,521%. That is a eye-popping number. Now, look, everybody, you've heard Joel and I talk about this before. Our perspective is a lot of the tariffs that are out there as a negotiating tactic, or quite frankly, they don't make real economic rational sense for us to do. But these ones, Joel, we'd argue, look, if you look at what Chinese industrial policy has done to the solar industry, it's understandable why with this, stuff like this, we're really talking about leveling the playing field, not trying to give ourselves an advantage. Fair?
China has overtaxed its people and taken that money, and overtaxed a lot of companies and taken that money, pooled it, and then grossly subsidized solar power companies, took all that country's wealth from areas that it should have stayed, frankly, and pulled it into solar so that solar companies in China could sell solar panels or photovoltaic, equipment of various kinds at price levels 20, 30, 40, 50, 60, I'm not joking, 70, 80% below cost to produce. 80%, which basically sent all kinds of European solar power supply companies into bankruptcy. All kinds of U.S. companies just said, I can't compete. I can't compete with a company that can sell way, 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 way below cost. It's impossible, right? That said, if there were any solar companies around that could benefit from a tariff on their competitors so they get a chance, some breathing room to actually survive, what would that be? Mr. Rob.
Right, and that would be everybody, right? Joel, thank you for setting that up so I can knock it down. That would be FirstSolar. For those of you who don't know, FirstSolar is pretty much the only show in town if you want to talk utility grade, big power plant solar panels, and really solar in general, made in the United States of America. And U.S. Solar, I mean, in FirstSolar actually has a pretty impressive footprint. I mean, you can see the numbers, right? 16,000 people employed, right? Tons of value added, tons of productivity. They've been really the only show in town because of the quality of their technology and everything else that has been able to compete while everybody else has been producing at below costs or getting to scale through artificial benefits. And even with that, Joel, they've still been a really profitable business.
It's been growing. It's just 22 is an anomaly because they got some government support at that point. But even without the government bump of 2022 for solar, right? That was the IRA, I guess, Rob, if I'm right.
Yeah, exactly. Yep, exactly.
And so they get this run up in profitability because they're finding, hey, they at least have a technology that even with what's going on, they can compete against China's super subsidized solar, right? And they've survived. Now, put on top of that a level playing field where China cannot, subsidize and sell solar for so much cheaper. And you have the opportunity as Wall Street analysts, are forecasting, the junior analysts again, that are forecasting the back of the research reports that we gather that FirstSolar should have a better year in 2025 than they've ever had, and in 26 crush that number. Meanwhile, what's priced into the stock? That this company is going to go back to a 5% return, right? To get to the stock price of FirstSolar, you basically have to say they will have no excess earnings. They'll have no real earning power. They're going to get the same return, not as the U.S. The U.S. gets a global average 12 to 14%. This company's going to knock down to the global average, meaning closer to where China is in terms of return on assets. And you can understand the narrative. The narrative is, look, it doesn't matter how good your solar is. If China keeps subsidizing, eventually you're going to fall to bankruptcy just like all the other players around the world, because how do you compete with a company that can sell stuff for free, right? Or for super below cost, right? It's impossible. Now, any of these, it doesn't have to be 3,500%. It could probably just be 300% or 400%.
Sure.
And you will level that playing field. And if that happens, right, and that's the bet you want to make, FirstSolar has tremendous upside.
And the other bear thesis is, this administration hates clean energy. And so, well, if this administration totally hates clean energy, why are they throwing 3,521% tariffs on other solar to help our solar? So don't think that FirstSolar is going to lose just because the Trump administration has a different view than the Biden administration did on the IRA. Also, let's just all remember that. And so you look at that, and this is what's so interesting, right? Is, this is a company that even before we had a more level playing field was making money. And now look at, because of how competitive it is, how profitable the company could be. And yet, because the smaller company, nobody on Wall Street is paying attention. And so, look, we started by talking about if you want a safe haven in a wild world, if you are worried about a recession or not, go to small caps and smaller uncovered and unloved companies. And we end with a solar company that's small and unloved that is an opportunity that you probably should pay attention to. You never know how we're going to get from point A to point B, but there you go. That's the Altimetry Authority Show. Thanks so much, everybody.
Everyone.
All right, thanks everybody for tuning in. If you want to hear more and follow us on a daily basis, just click the first link below and be able to track what we're doing every single day.